In March 2020, the global economy shut down, triggering a massive, simultaneous dash for cash across the financial system. It was the ultimate stress test for the post-2008 banking sector, as market participants aggressively liquidated assets and drew down credit lines to hoard capital. The banking system absorbed this shock largely because of a regulatory bedrock implemented to prevent a repeat of the 2008 collapse. That bedrock is the Liquidity Coverage Ratio, or LCR. The core purpose of the LCR is to ensure that global systemically important banks hold enough liquid assets to survive a severe 30-day stress event. Global systemically important banks, or GSIBs, are the largest, most interconnected financial institutions whose individual failure could trigger a wider global economic crisis. The rule relies on a strict, continuous equation: a bank's high-quality liquid assets divided by its projected net cash outflows over 30 days. HQLA includes central bank reserves and treasury securities, rapidly convertible to cash. By law, this equation must remain at or above 100%, ensuring the bank holds enough liquid assets to cover anticipated outflows over a month of panic. At a macro level, the system worked during the COVID-19 shock. The banks absorbed the massive inflows from retail customers seeking safety, while simultaneously meeting the liquidity demands of corporate clients. This line chart plots the median liquidity coverage ratio for U.S. GSIBs from 2017 to 2022. You can clearly see a visible dip during the first quarter of 2020, but the median remains safely above the 100% threshold. The macro ratio held. But viewing bank liquidity strictly through this top-line median masks critical vulnerabilities. When we look granularly at the denominator, the net cash outflows, we expose severe miscalibrations in the Basel framework's underlying risk assumptions. To understand these vulnerabilities, we have to tear down the LCR denominator category by category. We will compare the rigid regulatory assumptions baked into the rule against the empirical capital flight actually recorded during the COVID-19 shock. Surviving a regulatory stress test on paper means a bank met the legal criteria of a risk model. It does not mean the underlying risk models are fully immune to real-world market volatility. We start with the Federal Reserve's LCR disclosure template. This document is our structural map for analyzing exactly where a bank is vulnerable to a run. The template features two distinct columns. The average unweighted amount represents the bank's actual physical balance sheet stock of a specific funding source. The average weighted amount represents the regulatory provision. VOST is the exact amount of cash the Federal Reserve estimates will flee the bank during a crisis, dictating exactly how much liquid capital the bank must hold in reserve against that specific line item. Let's focus first on lines 5 through 8, the section governing retail deposits. For stable retail deposits, the regulation assigns a weight of 3%. This means that for every $100 million in fully insured retail deposits sitting in checking accounts, the bank only requires a $3 million liquid asset provision to pass the stress test. We can use a scatter plot to test if this 3% provision was actually sufficient during the COVID-19 shock. On the x-axis, we have the regulatory provision, the weighted amount. On the y-axis, we map the actual real-world capital flight. We establish a danger line with a precise slope of -1. If a bank's data point falls below this line, it means the real-world cash outflows mathematically exceeded the regulatory buffer designed to contain them. Look at the pre-COVID data from mid-2017 through 2019. The dots cluster tightly together and stay safely above the danger line, indicating very low volatility in retail deposit flows. Now look at the post-COVID data. There is a massive explosion in vertical dispersion, representing extreme volatility in actual retail funding flows as customers aggressively moved cash. We can quantify this gap directly. Between the two periods, retail flow volatility increased by a factor of 2.5. But the LCR weights governing those deposits, the actual provisions held by the banks, only increased by a factor of 1.5. The empirical volatility of the COVID shock expanded much faster than the regulatory buffers designed to contain it. If we move down to line 8 on the template, we find brokered deposits. Brokered deposits are large denomination funds placed into a bank by a third-party broker, rather than a direct customer. Because these funds chase high yields and have zero loyalty to the specific institution, the regulation assigns them a highly punitive 40% outflow weight. This scatter plot maps brokered deposit outflows against their specific provisions. We are looking directly at the extreme outflow volatility of this specialized funding source. Even with a strict 40% weight, the data points drop perilously close to the dashed danger line. The regulation proves mathematically less conservative for highly mobile brokered deposits than for standard retail funding. The risk escalates when we look at line 9, unsecured wholesale funding. Unsecured wholesale deposits are large, typically uninsured balances held by corporations or other financial institutions. When panic hits, this specific category of highly rational, uninsured capital serves as the primary historical fuel for rapid bank runs. This bar chart compares the volatility ratio against the provision ratio. During the crisis, the unweighted flow volatility for unsecured wholesale funding jumped to an alarming 6.2%. For some individual GSIBs, this highly mobile capital flow volatility tripled. Yet the corresponding provision bars remain comparatively flat. We see a massive volatility spike on the balance sheet, contrasting sharply against the stagnant growth of the regulatory provisioned amounts required by the LCR. When panic triggers the movement of uninsured wholesale capital, static percentage weights assigned by the LCR severely underestimate the sheer velocity of modern capital flight. The most complex mechanic in the LCR denominator is found on line 15. Line 15 calculates the regulatory provision for derivative exposures and collateral calls. Derivative exposures represent the financial risk from contracts whose value relies on an underlying asset, requiring banks to post cash collateral when market prices shift. Unlike the static percentage weights applied to deposits, line 15 relies on a 24-month historical lookback. It calculates the requirement by finding the single largest 30-day mark-to-market change over 2 years. A mark-to-market change is the daily adjustment of an asset's value to reflect its current real-time market price. This historical lookback creates a severe timing mismatch. Because the COVID-19 shock hit late in March 2020, the extreme volatility was mathematically diluted when averaged across the entire first quarter. The immediate LCR reporting muted the crisis. This line chart tracks weighted derivative outflows relative to the fourth quarter of 2019. Look at the delayed explosion in the second quarter of 2020. This is the exact moment the March volatility was finally locked into the 24-month lookback period. Driven by that strict historical requirement, several banks saw their derivative outflow provisions abruptly jump by over 50% relative to their pre-COVID levels. The consequence of this mechanic is a 2-year capital trap. The banks are forced to hold these massively elevated liquid capital provisions for 24 full months after the initial shock subsides. The look-back lag arbitrarily forces high capital requirements during periods of subsequent market calm, restricting capital deployment long after the actual danger has passed. Line 15 acts as a reactive phantom on the balance sheet. It ties up immense volumes of bank capital based strictly on the metrics of yesterday's crisis, rather than predicting tomorrow's risk. The derivative look-back mechanic highlights the overarching structural flaw in public LCR reporting, the illusion of the quarterly average. Banks report LCR figures as averages calculated over 90 days. This mathematical smoothing completely erases the reality of intra-quarter liquidity death spirals. This chart plots CME clearinghouse data, comparing the average against the maximum one-day change in initial margin, the upfront collateral required to cover potential losses. The flat average line completely hides the violent maximum one-day spike that occurred precisely during the March 2020 shock. A similar, massive disconnect occurred with variation margin calls during the exact same period. Variation margin represents the daily payments made to clear current mark-to-market losses on an open derivative contract. These single-day clearinghouse margin calls aggressively outstripped the smooth, average quarterly flows safely reported by the GSIBs to the public. The daily reality of the market was radically different than the quarterly reporting. Furthermore, past initial margin spikes are completely excluded from the LCR's 24-month look-back calculation, creating a massive regulatory blind spot for future liquidity shocks. Did the liquidity coverage ratio accurately predict and buffer the cash flight of the COVID-19 shock? The empirical data proves that while the regulation successfully buffers stable retail flight, its rigid percentage weights heavily underestimate the sheer velocity of wholesale withdrawals. A top-line ratio above 100% proves a bank survived the regulatory math, but risk managers relying solely on these quarterly, averaged LCR disclosures will be mathematically blinded to the sudden violence of daily derivative margin calls.